All right, everyone, welcome to today's webinar. Hopefully you can hear me okay. Like, just take a second, make sure the volume is good for you and the screen is nice and clear. Everything's coming through correctly. So if you could, or someone, just give me a heads up. Let me know we're doing things right, and we'll get started. On the screen, by the way, you should see just the markets right now. I have the S&P on the screen here. It seems like today's webinar is appropriately timed, as we're going to talk about shorting strategies today. Not a day too soon. Yesterday, quite brutal. So you should be seeing the SPY ETF. We'll use this area here just to kind of review and go through any examples slides that we may have. And it seems that we are good, live and running. So we'll get started. Okay, if you're brand new, I won't spend a lot of time on the idea of shorting. We've written a lot of great articles actually on this, and the concept is actually pretty simple. You can study it in depth a little more if you like to, but just think of it as the position starting by selling first, then buying later. Traditionally, we're all brought to investing, and we all learn the basics of buying something and hopefully selling it at a higher price. Basically, flip the two actions there, and we're just going to sell and hopefully buy it back at a lower price. If you want the exact definition, I think it's a pretty complicated definition, but if you think of it that way, usually pretty simple. Now, since we are shorting, of course, every penny or every price movement to the downside is how we would generate a profit with a short position, and then when we buy it back, of course, we would take our profits. If you're short something and it starts to move higher, your P&L will show negative. So just a brief overview there for maybe a few of you that have never shorted something before. On the platforms, it's all very simple. You can either hit the sell button or hit the short button. Some platforms have a short button, and that will take care of the transaction for you. To exit the position, you just hit buy, just like you would to buy a stock, and that will close out the position for you. Now, after yesterday, big down day, right? Biggest down day in a while that some of these markets have seen. And all of it was based on news. But if we put the news aside for a second, there are people that believe that that was a short opportunity. Now, I would bet that most of the people that sold yesterday were probably, people that have been long the markets. That's the S&P. If you look at something like the NASDAQ, it's pretty much been straight up. So you have to imagine that there are millions of people that have been enjoying a nice long position, and something scared them yesterday, a little bad news out of Washington, D.C., and you got to imagine that a lot of that was profit taking, right? Probably some new short positions in there as well, but the bulk, the pressure of all that selling is more than likely just people taking their profits. Not in any panic form, but just, hey, they had a nice run. They said, okay, that'll do. I'll take my money and run. So this is the first look at a weak day that we've seen in a long time, a real attempt to try to break trends, or at least the attempts to start to break trends on S&Ps, the NASDAQ, and so on. The question is, does this lead to more short opportunities? And if so, how can newer investors, or if you're joining us today, what sort of strategies can you use to participate? Now, this is a tough one. This class that we put together here, I'll admit is one of the tougher classes to organize, purely because where the market's at. The markets have been straight up, right? We can go back and look for months and years and see, basically we've been in this straight on uptrend. Here's a weekly chart. To be short this market is to be in a lot of pain and a lot of frustration. So there are not a lot of really great short positions that have paid large sums of money. Unless there's some kind of news, like a good example would be Brazil. And you couldn't possibly know this, EWZ. Maybe you read about Brazil today. Down 15%, the ETF here. That's all news. Right? So unless you knew the news was coming, there's no pattern there. There's no attempt by the technical traders to start a short position that they expected this big of a profit. And so because the markets are so strong, because everything's trending higher, it's not an easy time to be short. So I'm going to share with you today 3 short strategies that you can use, at least the start of them. We can build on them as we go. But keep in mind that it's probably still not the best time to be actively or, solely looking at short trades. Definitely keep some long trades in your back pocket as well. But if you were to decide to short, here's how we're going to do it today. We're going to put this slide over here just briefly. I'm going to share with you the strategies in what I feel is the good, better, and best. Now, there's nothing wrong with any of these strategies, but anytime you share a concept with people, everybody's different. Everybody has a different personality and they see things differently, a different type of trade. So we're going to include 3 different trades here, and you can decide, kind of which one you think is good, better, and best based on your, risk tolerance, personal preference, and maybe you just have a unique way of looking at the market. I know I have my own way, and I'll share with you which one I think I look at the most, but we're going to break it down just like this. And if you have no idea what type of short position you like or what sort of strategy you like, I would follow this good, better, best perfectly. Maybe you start with the best and then work your way into trying the other strategies. So that's kind of how I've organized it, but we'll go through 3 different strategies. If you have any questions, you can share with me anytime. I'm not certain that I can see them just yet. I'll load up the question thing in just a minute. But just feel free to post it, and I'm sure I will find it and get to it. All right, so we're good to go. We're going to look at some short strategies today. Actually, I'm going to put that back. Here's how we'll do this. We'll go through each strategy, and then let's go look for real live examples, things that we can see on a chart. And it's one thing to make a PowerPoint, but if you can actually see it, kind of ingrains it in your head, then when you see the opportunity in the future, you think, okay, maybe this is it. We're going to start with the good. And the title, the kind of summary of it is when a trader is going to be playing against the trend for something that he feels is a little extended and thinks will revert to the mean. Now, if you've joined us for our past few classes, this is really going to follow up on some of those discussions that we had. We're going to focus on now the opposite. Okay, we talked about playing the trends. We talked about how to tell whether you're paying retail price or a wholesale price. And so with this first strategy, we're going to say counter trend extended. Okay, now let's highlight that on the charts real quick to show you what does that look like. Basically, remember, we're talking about shorts here. I'm going to try to use ETFs if I can. We're talking about the idea of a stock moving in one direction and us believing that that trend is about to change. This is not easy, but we're going to hone in on a specific time where you could do it. So I'm not saying, hey, find a uptrend and then just start shorting and see what happens. There are specific areas that we can really hone in on here. So if I take this guy here, oh, that's not it. Sorry, one second. I'm gonna go, let's go like this. Okay, that's better. All right, counter trend extended. What we're looking for in particular, we're gonna have a couple main points here. We're looking for a chart. Now, I put daily on here. I'm primarily just gonna use the daily charts, assuming that most of you are not day traders, that most of you are short-term traders, if not long-term traders. Now, from our previous discussions, just remember, if you're a shorter term trader, you'll use the daily chart. If you're that long-term trader, go ahead and use the weekly chart. You'll find the same setups there, but you'll be kind of investing for the long term, or in this case, shorting for the long term. Now, first part, we'll focus on the daily chart. We want at least 3 days higher. And it's not just one move of 3 days. We're looking for something abnormal. If you're believing that a stock is about to change trends, then the most common thing to look for is that it gets extended. Now, how do we define extended? We did a couple other seminars on this, but the primary and the most easiest way to see if something is extended is by using the moving average. You can use any moving average, but we focused on that 20-period moving average, which on my on my thing here is the green line. I don't know how to get rid of this, or I would, but the green line represents the 20 moving average. And what we're saying is something can become extended if it moves far away. We did a lot of great examples of how to buy those pullbacks when it's not extended, just to play a trend. And today we're going to flip the script a little bit and say, hey, look, if a stock has at least 3 days up in an aggressive fashion, that's something we want to look at for a short. Remember, this is the good strategy. This isn't the best strategy. This is just the starting point. Okay, so tell yourself, okay, I need at least 3 days. And what you want to see is, I say aggressive, but you want to see greed, really. You want to see people get so excited that they chase the stock day after day after day to a point where it becomes extended from, in this case, the 20-period moving average. Now, we know from our prior classes and from any example that you want to share that the 20 moving average acts like a rubber band. You can only pull the rubber band so far before it'll snap back. That's my best example I can give. And that's what this counter trend extended trader is going to look for. He's looking for that brief moment of greed that won't last, right? That pocket of air where everybody buys, and then sits back and says, okay, what happens now, right? There's no more buyers. Everybody's chased it. We've all bought in. So the other part to that, of course, be far from the moving average, okay? And I see at the bottom I put if you can get a volume surge, that's a bonus. In this market right now, for the past couple years, very difficult to find that extra bonus if you're going to be one of these counter trend traders. But here's the idea. When you have those 3 days or more that shoot straight up, get really extended, you can play for the move, the short, back towards the moving average. And a lot of times that's just going to be your target. Anytime I do this, I can never wait for that as a target. I never seem to hold it for that long. But it's a target. If you get the move, it starts moving lower. Generally, I start getting out as it heads towards the moving average. But a great target, of course, is the 20 moving average. And that's just the rubber band effect, right? You're going to see that over and over again. But the key point is that it gets extended. And when I say volume surge down here at the bottom, just if you can see some heightened level of greed. This is not the best volume charts. I don't like these that much. There are other charts that can actually show you when the volume is trading above average and just puts a nice little line there. But for now, we'll just say that's a bonus. Now, why is it a bonus, though? If you do happen to have this on your charts, the volume, why would we say it's a bonus? And the idea is really simple. If the volume is high and trending higher with a stock that's just rocketing, right, that's just shooting quickly higher, what that's telling you is the buyers are, first of all, in complete control. There's just no argument there. But it shows you that everyone that wants to buy is diving in. Whereas on a normal trend, something like this over here that's real slow and steady, the buyers just pick their points. And there's different strategies triggering all throughout here that cause more and more buyers. When something gets extended, anyone who wanted to wait to buy the stock is not going to wait. They're saying it's taking off without me. I've got to jump in. Anyone that has a strategy here that takes effect, they're also buying. Any short traders, people that were short for some reason right in here, they are maybe exiting their position. And remember, to exit a short position, you have to buy back. So the volume is really created by all this sort of greed and a little bit of panic from the shorts. That doesn't last. It doesn't stay like that. Everybody, it's like a gun. You can shoot the gun as many times as you want, and eventually you're running out of bullets, and the gun doesn't make any more noise. Once that happens, there's this natural drift back lower. Any sellers that are wanting to short that or wanting to sell to take their profits will have a greater effect on the stock because the volume is now spent, right? Everybody spent their ammunition going higher, so therefore the pullbacks tend to be very quick. It's not one where you see it blast off and then sit for 50 days and then pull back. It's usually very quick up and very quick down. So for a short-term trader, Awesome. That's the kind of thing you look for. If you're the long-term guy, you'll just change to a weekly chart, and you're going to try to find your opportunities there where a stock spends weeks extending itself and then maybe a few weeks pulling back. Okay. I don't have a great example of that at the moment, so I'm just saying that. It doesn't matter the time period. Yesterday and today too. If you're short-term day traders, you've had plenty of opportunities where things were so extended and snapped back a little, and got extended and snapped back a little. So that's the first idea. Now let's put this back in here. The last two spots, squares, we're going to highlight the pros and cons. Why is this only a good strategy? Seems like it, something blasts off, I short it, it pulls back quickly. Even if I'm a little off, if I happen to short a little early, it still pulls back. As long as it comes to the 20 or close, I should be fine, right? The reason this to me is just kind of a good strategy, number one, is because the markets. You're fighting a very strong market. Just be honest, just straight up for 9 years. Hard to be short in that market. The other thing is, well, let's do the pros first. You're going to get that faster profit. Fast shot up, fast shot down. You take your quick profit, you move on. Risk goes on, risk comes off, and you can then go find something else to do. It's also very popular. Day traders and short-term traders, very, very popular for people to want to bet against the trend. It's one of my favorite things to do. I'm kind of picky, but I like to bet against the trend, especially when it gets extended. You can be a little sloppy, meaning you can be a little off and not have the best entry and still walk away with something, right? So it's a very, very popular strategy. So those are the two greatest benefits from it. In and out, and you know that you're being joined by a bunch of other people at the same time. The negatives are quite negative, though. This is why this is only the good strategy. The first one, stop placement. Let's go look on the charts again here, and I'm going to use Apple as an example. Okay, this is Apple real time. This is a current day here as it's trading. What happened over here? Here's Apple, and we could all say it's up for at least 3 days and finds itself extended. Normally, it stays pretty close to the moving average, and this, for whatever reason, it decided to move a little bit quickly away. Now, let's just say you shorted it right here, and let's say you got a great price, 154. Let's just pretend you did the even number. Okay, so I'll say, all right, you followed everything that you were taught. You did 3 days up, and we found an entry right there, 154. You see what happened after that? It still pushed a little higher. In fact, 156.65, you had to watch it go $2.65 against you before you ended up getting the move, which you did, and you will always get that move, but you had to suffer a little bit of pain right there, right? This is one of the big negatives here. You got to be careful because it's not always an obvious spot to have a stop. If you're going to use a stop loss, it's difficult. In this case, you're at new highs, so you can't look back and say, oh, well, there's resistance or there's some form of resistance. So that's why I say this one, it's a good strategy. It's just not the best because you have that pain. Right? I don't know how to say it. You have this point where you're going to have to sometimes take a little pain before you see that. And not everybody can handle that. Because of that, that means that this strategy potentially has a lot of risk for a small or quicker reward. Meaning, we know that the target is the 20. We don't know what kind of risk we're taking at this point. Would you have let it go $5 against you, 10? How do you know where to stop, right? Now, some stocks they'll have resistance, right? But right now, with the market so strong, almost everything that gets extended is making a new all-time high at the same point. So you just don't know how far it's going to go, okay? Now, to me, those are some pretty big negatives there. Now, does that outweigh the potential for a quick profit? Maybe, oh, yeah, it's only a couple of days it moved against me, and then wham, it came back. That's for you to decide. I like it. It's fun for me, but it's something you got to know what the magnitude of a stock can be. How far can it move? So you can determine your position size. Okay, then the last sort of negative here, and I really use this for just this market, is consistency. There's not a lot of these, right? It's kind of difficult to find the quick pops that turn into pullbacks. Now that'll change. If we start selling off here for the summer or start moving sideways, there'll be a lot more because news will become a focus. Right now, most of the stocks are just following the markets. Occasionally there's some news in there, but most of the time they're just following what the markets are doing. If the stock market starts to move sideways, then what happens is traders will look for news to place their trades. Just meaning they'll spend less time worrying about the trend, more time looking at the news, and if they think it's good news, you'll see the stock pop. If they think it's bad news, you'll see a down day, irregardless of what the markets do. But we're not there yet. So I put consistency in there just for this particular market. Things could change, and then I would take that off. Okay. I don't think I can see any questions. If you have them, still, do I hit Q&A here maybe? If you have any questions, go ahead and plug them in there. We'll move on to the next strategy. I see group chat. I do not see normal chat. Okay, I'm going to move on then. We'll go to our next strategy here. We're going to talk about better. Right? And this just kind of follows up on the opposite of what we talked about last week. We worked on some breakouts, just giving you an idea of what they look like, how they work. Now we're going to flip it. And it's not just as simple as flipping the strategy. Breakdowns are a whole different animal. If you've ever tried them before or have any experience with them, you know that a stock that breaks out is a lot different than a stock that breaks down. And we'll go through that here with some examples. Okay, so basically what we're looking for is the same look as a breakout, but our goal is to play it to the downside. All right. So for anyone that wasn't here, I'm going to go through. We'll go through a few examples here that we were looking at, and one that is happening right now. So here's the stock JEC, and you can see it has this range, pretty much equal highs, but more importantly, equal lows. Very, very popular. Everyone loves to look for these. And this is the idea. You've got a stock that's weak. Okay, there's no overall strength. You can't say that it's been up for the last few months and it's just taking a break. Our argument here is it's been down for a few months and now it's taking a break. Well, that's not good, because normally stocks that sell off and pull back, they tend to find a price that people say, well, that's a good value. You know, that's a good price. I think if I own it here, I'm getting a good deal. And then you see the trend change. But it's not happening. Instead of it bouncing, instead of people finding value, people walked away. You can even see on the volume down here, the volume gets kind of quiet. Nobody's really interested in making a big decision one way or the other. Okay. Now, we're looking for the obvious support. And of course, when it breaks under that support, that's the moment in time for a short. That's the traditional breakdown. So pattern-wise, pretty much the same as a breakout, but flip it upside down, and you can even see when it does start to break down. And it's fun to watch in real time, because you see how as it moves down, based on certain days, you could see the volume start to spike. That's just everybody getting in a little early, right? People saying, oh, I'm going to short a little bit here, and then when it gets there, I'll short a little more, and then when it breaks, I'm going to short a little more. You can really see it on the charts down here. Oh shoot, right here. There we go. This sort of volume area. All that is people just jumping the gun a little bit, and the last of the sellers starting to get out. So the sort of pattern that you're looking for, if you're taking notes, we're looking for sideways consolidation. That's the fancy way of saying what we just drew there. And the obvious support. The reason we put that there is that's your entry price. You have no way of knowing if it's going to break down unless it breaks support. So at some point, you have to pick a number. And it's not always perfect. You can look at this low and then go over here and look at this low and say, okay, fine. When it breaks that, I'm going to go ahead and get in. Well, that's some number. Say it's 80, say it's 52.50, just to have a number. So your short entry is just anything under 52.50, right? Everybody else has the same idea. You can even see at that same point. But the reason we've got to be able to identify obvious support is for that specific entry. If you find something that's just wiggling around and moves $1 below and $1 above and $1 below, yeah, that's your trend. That's a sideways movement, but you don't know what the actual entry is going to be. So we want to be able to pick a spot, not only for you, but we want to be able to, not only for you, but we want to be able to say, that's where I expect everyone to short as well. Okay. So yes, you want to have a price, but you also want to know that there's a price where somebody's going to jump in with you. All right. Perfect. Okay. So traditional breakdown, pretty simple strategy. I think it's one of the better strategies. That's why I put it in the middle there. And the biggest, exciting thing about the breakdowns, or breakouts for that matter, is you know your risk right up front. Unlike this previous one over here, we had no idea what our real risk was going to be, and our reward, it's the 20 moving average. Well, with a breakdown, you know your risk, and you know right away how much that's going to be. Now, here's why we say that. If you're going to play a breakdown, you know your entry price, and you know that, all right, maybe it wiggles around a little bit, but if at any point it goes over these highs, it's no longer a breakdown. In fact, it's no longer a sideways consolidation. Every technical trader on the planet's going to say, well, that's now going to go higher. So every time somebody plays a breakdown, the prior highs, the top of the range, is always their stop. Guaranteed every single time. It's if I could find an example where one doesn't work and turns around, you'd see that right at the point where it crosses the highs, big influx of volume, and it pushes higher. It's just because everybody uses that as a stop loss. Now, not every breakdown is going to work, and that's okay, right? It's part of the trading game here. But if you know where your stop is going to be and you know your entry, you can very easily determine your risk. If you're willing to risk $300 on this trade, well, then that's perfect. You put your stop here, you short 100 shares here, and you go for the ride. So your risk is always defined. Now, sometimes these little ranges are really tight. Macy's is a great example. Sometimes a stock is just out of favor. Nobody's talking about it, or there's a bunch of news and then people say, well, I don't know what to do with this stock, and it doesn't do anything for a while. You could tell by the volume that basically just the day traders are playing in there. Well, when a stock like this breaks down, you get a bigger reaction. So draw the lows here as best I can and the highs. Now look at something like this. This range is incredibly, incredibly small. Whenever you see something like this, if it breaks down, you usually get a severe breakdown. Versus JEC, wider range, right? When it breaks down, yeah, it's doing okay, right? I don't know that it has a huge collapse, but it's doing okay. Why would this one not fall as much, but something like Macy's fall a ton, really? I mean, a big, huge move. And this applies to day trading, anything you want to call it, whether you're day trading or long-term investing. Anytime there's a small range, let's pretend we're thinking about shorting it. Well, we look at it and say, okay, here's my entry. I know I want to use a stop loss here. Holy cow, that's a small stop loss area. That means I can short a bunch of shares. Let's use the previous example. We said we'll lose $300, okay? If you say, all right, I'll lose $300 on this one. It's a $3 stop. Simple math. I'm going to short 100 shares. But let's pretend you come across something like Macy's. It's a tighter trend. And you say, well, I want to short here. I'd like to stop out here for a $300 loss. But all of a sudden, it's only a $1.50 stop. Now I can do 200 shares. That's just you. Imagine every person that wants to play this breakdown going, ha, it's only a $1.50 stop. Some people are only going to want to risk $50. Some people are going to risk thousands of dollars. There are plenty of traders out there that say, I'll risk $1,000, $2,000, $5,000 on this trade. Can you imagine how many shares they're going to short here versus how many shares they can short over here? It's not as many. You can't justify the risk, right? And that's why the tighter the consolidation, the tighter you can find, the bigger the move. It's just, we all know the risk is focus, and we all can increase our position size. Look around at some other ones here. You've got something like General Electric. Now, not only is this the breakdown, but also has some moving averages coming into play. And if you've been at our past few classes, you get to see that. Right? We're building every time we do these on new topics. So same concept here. General Electric. Now it looks large, but General Electric doesn't really move a lot. So here's say 29 to 30, 50. Not too bad. It breaks down and everybody gets to participate. Notice that this is where everybody's at, right? Everybody wants to be there right as it happens, and then you can, of course, add more as you go. All right. There's not a lot of great examples, currently because of the way the market is. Here's something like a JP Morgan. There's a couple other things going on inside of here too. Really, really cool. But same idea. Everybody knows that, everybody knows they've got this series of equal highs. If you want to take it one step further, you can look inside here and say, it was moving sideways, and then it looked like it was going to break out and gave it all back. That's even worse. That means if you're thinking this stock is weak, it's just telling you right in your face. It's confirming it. So same thing, small range, big move comes out of that range because there's such little risk. Okay. So really, if I were to go back to this, if you keep the slides or whatever, sideways consolidation, but you might sneak in there, the tighter, the better. The smaller the consolidation, the better. All right. Anyways, so you can see how sometimes you'll have very small risk and the potential for a larger reward just because of the magnitude of everybody else pushing that stock lower. And probably the best thing about them is this strategy is kind of easy to find. Right? You can set different scanners for them. They'll do it for you. Or if you were to just go through and pick a list of, say, like S&P 500 and just start scanning through them, it's very easy to go, is it moving sideways? No. Is it moving sideways? No. Sideways? Nope. 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 Right? And keep going until you go, here's one, moving sideways. If it moves under that range, that might be something I'm interested in, and then just write the symbol down and come back to it. So you don't need anything fancy as far as, the scanners if you don't want them. Here's another one. And just a couple clicks, you're able to find at least a few possibilities. And it's just easy to spot, right? So that's probably the best thing. All right. What are some of the negatives about the breakdowns? It doesn't happen a lot right now. I haven't found a lot of good examples of it, but in a sideways moving market, now the stock market, if the S&P, the NASDAQ, if those are moving sideways and you find a breakdown, you really don't know if the stock is ready to break down, or is it just moving sideways because the market's moving sideways? So while it's not much of an issue right now, that's a definite negative that we want to talk about. Whiplash, meaning you shorted it and it immediately turns around, goes all the way back up and hits your stop price, right? It happens. Right now, like I said, it's not much of a big deal. You could use this as an argument here. Let's pretend that this is a breakout, right? And everybody said, I'm going to buy it. And then it immediately reversed and hits their stop. Something like that, but upside down. Don't forget that. That's definitely a negative to keep in mind. Like I said, don't see a lot of it right now, but you will. It's part of the game. Okay, the other negative, slippage. If you've never heard the word before, it's the difference between the price that you hope to get in and the price you actually get in. That's the slippage. And it's very common, especially with the tighter breakouts, because everyone wants to play. It's such an easy strategy to find. We all want to play at the same time, and they're sometimes isn't enough shares for all of us to short at the price that we all want to play. Macy's would be a great example of slippage. So the stock's moving under the range here, and everybody decides they want in. Now, it gaps lower, which means you'd have to short it pre-market, right, and be in there. I don't show the pre-market data, but you'd either have to start participating early to get in, or if you had a short order set up ahead of time to get in, say it was a short market order, remember that class we did, you'd be very disappointed with the entry price, at least temporarily. Because when the market opens, you said, hey, I want to short at this price, but I'm willing to short at any price, right? So that short market order, of course, is going to, or short stop market order, of course, is going to trigger on the open, and you would see that slippage between where you wanted and where you got in. Okay, it's not always this bad, but this is the most obvious example I can use to really highlight the point. Okay, day trading. If you are looking at something like this and it happens to be a 5-minute chart or 2-minute, whatever you use, it's moving around, and as soon as it moves under, you decide to short. Well, every other day trader is going to hit short at the same time. So you want to make sure that you're shorting a stock that has volume, right? A stock that can actually offer you those shares. If you choose a no-name little stock or something, I don't know, I can't think of any, but something like this, there's not a lot of volume here. If you were to short and 10 other people decided they wanted to short at the same time, if you were even able to short, chances are you get a very poor price. So try to stick with the bigger names if you can when you're looking at stuff like that. General Electric, no problem. You can short 10,000 shares at that point, and you would have got a good fill. So it depends on the stock, but definitely pay attention to slippage. And that goes back to our first class on volume. The volume that you choose, the stock's volume for the strategy you hope to use on that stock is very important. And you kind of learn over time which stocks, kind of fit what you're looking for and which stocks don't. All right, so that's our better strategy. Good? Everybody's good with that? If you have any questions, feel free to post them in there. I think we're pretty clear so far. So we have the good, the better. Now we're going to talk about the best strategy. And this one, this is for two types of traders, I'll say. The first is the newer trader. The best strategy, I think, for you to follow. The second type of trader that it's good for is a trader who's recently struggled. We've all been there, right? You have a rough streak. You're not winning on the trades like you were. And you need something to come back to get you focused again, to get you confident. And so that would be this one. Okay, so whether you're new or whether you're an expert and you're just having a little rough time, I'll focus on this strategy. It's the easiest, it's the most relaxing one to use, and of course, it'll be easy to identify. And that's simply a stock that's trending lower. Plain vanilla, just a stock that started at one price and for some reason just slowly keeps moving down and down and down. Okay. Now, we did this example as a long trade where we were buying different areas. We introduced the moving averages, the price support, and things like that. Great. That's for a stock that's trending higher, and they're everywhere. Of course, you can find those everywhere because the markets are straight up. But there will come a point, maybe over the summer when things are a little bit lower volume, but there will come a point in general where stocks just trend lower. Right? And just nobody seems interested. They sell off slowly, and that's just the way the market will be. Unless you've traded for longer than 9 years, you have no experience with a lower trending stock, or probably not very good experiences with lower trending stocks because there really hasn't been any. But there's a few things we can look at here. All right. Okay. The first thing we want to do I'm leaving the day traders out of this picture for now. We're looking at the daily chart or the weekly chart if that's your longer term focused trader. And we want to see that the trend on either the daily chart or the weekly chart is nice and steady. We don't want a stock that's going bankrupt, right? We don't want a stock that's surrounded by scandal. We want a stock that's just out of favor or in an out of favor sector. Right now, the out of favor sector is energy. The ETF is XLE. There it is. It's not that anything's wrong with these companies or that they're all stealing money or in some investigation. It's just that nobody likes this sector right now. And as money, you heard of sector rotation. As money moves from this sector over to tech or wherever it's at now, tech seems to be the hot one. Well, people start slowly pulling their money and moving it into the better performing sectors. That's what causes a nice, clean, trending stock. There's no panic here. There's just little dips and little rallies, little dips and rallies. And that's the bulk of what we're looking for. You don't have to catch it on the top, right? You can see it happen for a little bit and participate. But a steady trend is very important. Macy's, let's go back to that for a second. Yes, that's a lower trending stock, but based on news and panic. Okay, there's a lot of bad things going on with Macy's, or at least there was. I haven't followed in a while, but they're not doing well. And so you get these jittery moves, these quick moves down that you can't do anything with. How are you supposed to spot that? And then rallies that don't make any sense. There's very brief moments of trending on a stock that has either bad news or is just not doing well in general. So I'll take you back to the XLE for a second. And we want to participate with short entries on a steadily trending lower stock. How are we going to do it? What are we going to look for? If you've been around the past few classes, we're looking for the ability to short at a reasonable price. We don't need the best price. It's almost impossible to get the best price. We don't need the highest price. We just want a reasonable price. And that green line, the 20 moving average, always tells you what's reasonable. Whether you're right or wrong, you can confidently say, I am entering this position at a fair price, okay? And so what you're really looking for is just any attempt to move back towards the moving average. And you're going to short it there. And then another attempt. Remember, it's a rubber band. It's not a perfect ceiling. So you're going to have to see little pokes above and below. You can change the moving average also. I just like the 20 because it seems like everybody else uses it. If you found that the 25 became popular and all of a sudden everybody's talking about that, we can change it. But the 20 has kind of withstood the test of time, at least for the last 15 years now. It's one of the more popular moving averages for the short-term trader. So that's going to be your target zone. Just like we talked about the buying on the buy side, now we're going to be looking for shorts. What you don't want to see, though, I'll give you one thing to stay away from, is if the stock is trending lower nicely and calmly, and for some reason, let's say it was here, and the next morning it starts at the 20 moving average. If it gaps up and immediately gives back all of its losses to the downside, we're going to avoid that one. We want to actually see traders trade throughout the days to push it back, and traders actually trading throughout the days to sell it off over and over again. Okay? So, very important, steady trend. No news, no panic. You want the sector or the stock that's out of favor. Now, the good thing about this is if you find it, your success rate is very high, right? And that's why I say for the trader that's struggling a little bit, having a little bit of a rough time, it's a great thing to come back to because it doesn't take long to find downtrending stocks that are just out of favor and just participate. Every couple of days, be able to get a short, make a little money, build your confidence back. If you're a newer trader, of course, you want the higher success rate. You don't want to lose all your money. So if you can get something with high success rates, it helps you learn faster. You're learning from a position of strength, not a position of fear, which a lot of people do when they're just learning. Maybe they bet too big or whatever happens. A lot of times the newer traders learn out of fear, and that's not cool because you learn that habit. It's not a good thing. Okay. The other thing is you have a very limited risk, right? Just like the breakout, we know that right around that 20 moving average is where you want to participate. If it happens to shoot beyond that or shoot beyond a prior high, then that's probably something you don't want to deal with anymore. You take a stop loss and you find another one to trade. So we would say that the risk is limited, but technically the stock could just keep falling and trending lower. So you do have a larger potential reward. Okay. So again, simple, easy trending stock lower. You're going to have these days where it does fall aggressively. Fine. That's maybe a good profit taking spot for you. Depends on what you use, but that's the idea. What are the negatives? If you are shorting a stock that's trending lower and you can't find any reason why, and you think, oh, it's just coming out of favor, that may be so. But if you're trading individual stocks, one little bit of good news could send them higher. Because remember, people that are short have the understanding that they could technically lose a lot of money. And so if there's any news or anything to scare them, they're likely to get out. And whenever a short trader exits a position, it's a buy. It's a buy order, right? So it's going to, if the size is big enough, it's going to push the stock higher. So news events can be big deals. Twitter is a great example of that. Now, Twitter was trending lower. It was just beaten up anyways. This thing has been surrounded by news for, a couple years now. But here's a great example where it's a stock that's trending lower, and all of a sudden there comes out some news, rapid fire news, and over the next few days it just shoots up like crazy. Okay, so we want to try to avoid any stock that just has news. Like I said, it's got to be that sort of boring stock that nobody's talking about, it's just floating lower. If you find yourself getting stuck in some kind of news, usually the best thing to do is just to exit, right? If you're short and the stock starts to move against you with some news event, you got to just count that one as a loss and move on, in my opinion. So news, that's a negative thing. It's really a negative thing for any short position. You could be short at any point and news comes out. I mean, you could be long at any point and news comes out. It's just the way the markets are moving right now. News has a pretty good impact. Okay, the other thing is shares available. Now, the standard or the traditional definition of shorting means that you're borrowing shares from somebody because you don't have the shares to sell. Remember, we're going to sell first, buy later. So if you need to sell, you have to have something to sell. So what it means is the platform goes and borrows the shares from somebody, lets you sell them. Then when you buy back the position later, they return the shares back to the original owner. That's how shorting, that's the complicated definition of shorting. Now, there's not always shares available to borrow, and you'll get a little warning. Your platform will usually tell you if there's no shares to borrow or if it's hard to find shares to borrow. I can't think of any names. You'd have to pick some cheap stock probably. Oops. I can't find any symbol at the moment that's not available, but it can happen. You could be wanting to short something, and if everybody else has the same idea, then your platform might say, hey, sorry, we can't find any shares for you to borrow. And that's what that means down here, the shares available. Now, most of the time, if you're trading the popular names, bigger names with the volume that we've talked about in the past, it shouldn't be a problem. There are occasionally these panic days where they'll stop you from shorting, but I haven't seen that in a long time. Other than that, no problem. If you're going to choose penny stocks or these $2, $3 stocks, if your brokerage firm even lets you short those, there may be days where you can't find shares available, and that's the message you'll get. We can't find shares available, or shares are hard to borrow. So that's one of the negatives there. And I'd even like shrink this, make it smaller. Not a problem that most of us are going to run into, but it is something to consider. Okay. Okay. So awesome. I feel like I got done. Yep, just a little ahead of schedule. But these I will post for you to take with you if you'd like. These are the slides that we just went through, and in order. Right? Good, better, best. I'll leave it to you to decide whether you want to rearrange them. You might find that there's a better order for you depending on your style. It's just depends on your expertise and kind of your experience. Okay. All right. We've got the good, better, and best. If there are any questions, I did finish a couple minutes early here. I'd love to help you with anything that I could cover for you. And we'll see. This could be a class that we could revisit. Hopefully, if the markets ever did pull back, it'd be great to use this class like this in a market that does have those kind of short opportunities. But for now, shorting is still a bit difficult. I'm also going to put this over here. Here's our website. Feel free to check it out. Also have the upcoming webinars, anything interesting, and the articles that I write along with a bunch of other people. More help there. And I'm always talking about some kind of technical strategy, anything that I can elaborate on or that leads up to any live classes that we're going to do. So feel free to check those out as well. Or send us an email. Keep in touch with us. Let us know what live classes you might be interested in doing or hearing us do. I've covered a few already, but if there's something that you feel we could touch on a little bit more, send us an email. Find us on social. All right, looks like I did a good job. There are no questions at the moment. I'm going to give it a few minutes, though. I don't want to cut anybody off. If you have any questions, feel free to type them in there, or we will wrap it up soon. All right, it looks like we're good to go. We will be back with another webinar. Stay tuned, and hope you enjoyed it. Leave us a comment. Let us know how we did, what we can do better, and we'll see you next time.